Joining us is Lending Tree Chief Economist Tendai Kapfite and Yahoo Finance's Emily McCormick. Also joining us from California is Western Asset Portfolio Manager John Bellows. All of you, welcome. John, let's start with you. When we talk about the Fed, okay, we expect 25 basis point cut today. We're going to look for language to indicate when the next cut may come. The expectation is October. By the end of the year, we're in a range of 1.75% to 2%. Missing anything here? What are you expecting?
Well, I think one of the most important things today is why. Why is the Fed cutting interest rates? You know, the economy has been performing relatively well. Financial markets are obviously performing relatively well. And so there's a question of why. For us, the why is that inflation is underperforming the Fed's target. It's been underperforming the Fed's target for a number of years. It's again under their target this year. And they're increasingly worried about that. They need to reestablish their inflation credibility. That means reacting to low inflation, and they're taking a first step towards that today. So what we're looking for, in addition to the things you laid out, is some discussion of that, some discussion of the why. I think there's going to be a focus on inflation, and that more than anything is really going to provide us a roadmap of where we go here, is that discussion of the why.
John, when we talk about the why, though, doesn't this conundrum also suggest that there's been some sort of structural change in the economy that means even if the Fed does cut, it's not necessarily going to have the intended or wanted effect on inflation? I mean, after all, even though they're cutting from a very low level to a very low level, right?
I think that's right. I think that, you look around the world and the persistence of these deflationary forces is very striking. Mario Draghi is dealing with the same thing. Obviously, Japan is years ahead of the U.S., but dealing with the same thing. And so the deflationary forces are quite persistent. And that really raises questions about the Fed's ability, or any central bank's ability, to meet their inflation target. So I totally agree with you on that. What I would say for the implications for the outlook, though, is if the Fed is really and truly now focused on inflation, it really changes the way you should think about the Fed going forward. This is not a Fed that's going to keep hiking even though inflation's low, but instead it's a Fed that's going to keep reacting to low inflation by cutting interest rates. And so, our view is today's cut is unlikely to be the last. As long as inflation remains below target, I think the Fed's going to continue to respond to that. And again, I think that's the most important thing we're looking for today, is some discussion of the why, and then that informing the outlook going forward. And you're right, as long as it's focused on inflation, it really changes, how we should think about the Fed going forward.
John, I find it really interesting that you brought up inflation, and you also mentioned the EU and you mentioned Japan, where I think we've learned from those economies that if there's other structural issues in the economy, cutting rates isn't going to create inflation. So is this inflation argument the Trojan horse for what I think is really going on, which is the quest for a weaker dollar?
Yeah, I think the dollar may be in their models to some degree. I think they need to be careful with that. The dollar is obviously not part of their mandate. Inflation is part of their mandate. I think more generally, what low inflation is telling you is that we can have more growth in the United States. The only constraint on growth was thought to be inflation. So inflation's not picking up, and there's no reason why the Fed or other authorities can't pursue a more growth-oriented forecast. So rather than the dollar, what I would say is what's really going on is the Fed is more growth-oriented and more interested in promoting growth than it has been. And the reason for that is because there's no binding inflation constraint. So absent a binding inflation constraint, I think the Fed is right to focus on growth, and I think that's what's going on. And I think that also kind of speaks to what's going on in Europe and Japan. Is they're also having somewhat of a shortfall in demand, especially in Europe, and similarly growth-oriented policies, and that's appropriate as long as inflation's becalmed.
John, I want to ask a little bit about the balance sheet runoff process. So that's scheduled to end at the end of September, but do you see the Fed potentially moving that up just to avoid sending conflicting signals about easier monetary policy while at the same time continuing tightening in the form of the balance sheet runoff?
Yeah, I think the first thing to say on the balance sheet is that it's not really clear on the economics that 2 months here or there matters all that much. They've been running off for a while. I think most of the research on the balance sheet suggests that the signaling mechanism is perhaps more important than the actual size of the balance sheet. And so from an economics perspective, 2 months here or there, I think is probably unlikely to matter. On the signaling part, however, I do think that ending the balance sheet runoff enhances their dovish signal that they're intending to send. I also think Chair Powell in the June press conference more or less foreshadowed that the balance sheet runoff would be ending at this meeting. So, I think it matters from a signaling perspective, not so much in the size of the balance sheet or economics perspective. And I do think that he signaled pretty strongly on this. And so you put that together, and I do think they will end it today, both because he kind of pre-committed to it, but also because the signal matters, and the signal today is dovish, and that's what they want to send.
All right. We want to appreciate your being here. John Bellows is the Western Asset Portfolio Manager, keeping an eye on the Fed, as are we all.
Great. Thank you.